Something just shattered in the global silver market. And I mean shattered completely. Ladies and gentlemen, Asian guy here. I need you to stop everything you're doing right now and focus on what I'm about to tell you. Because what happened in the last 6 hours isn't just a price move. It's the sound of the entire Western financial system admitting defeat. While you were sleeping, while the mainstream media was distracted by their usual nonsense, the Shanghai Futures Exchange printed a number that should terrify every banker from New York to London. $127 per ounce. That's not a typo. That's not a glitch in the system. That's the real price of silver right now on the other side of the world. But here's where it gets disturbing. At the exact same moment, the COMEX in New York is showing $74. Look at your screen right now. Shanghai, 127. New York, 74. That's a $53 spread. $53. 50. Let me explain what this means in terms anyone could understand. Imagine selling apples for $10 while your neighbor sells identical apples for $25. How long would that last? 30 seconds. Everyone with $10 would buy from you and sell to him for $15 profit. That's arbitrage, the most basic force in finance. When prices diverge, armies of traders with supercomputers should close that gap in milliseconds. But it's not happening. The gap isn't closing, it's widening. This morning it was $40. 2 hours ago it was 47. Now it's 53. The arbitrage mechanism, the thing that keeps global markets connected, that keeps prices rational, that prevents exactly this kind of chaos, is dead. Completely dead. And dead arbitrage doesn't just mean broken markets. Dead arbitrage means broken system. Let me walk you through what should be happening right now. Every major bank, every hedge fund, every algorithmic trading system should be screaming buy orders into COMEX at $74, chartering cargo planes, loading silver bars, flying that metal to Shanghai and selling it for $127. It's free money. The easiest trade in financial history. Buy at 74, sell at 127, pocket $53 per ounce with zero risk. But they're not doing it. They can't do it. And when the smartest, greediest, most connected financial institutions in the world can't execute a $53 arbitrage opportunity, that tells you something fundamental has broken. The surface explanation is simple. China's export licensing system has created a paperwork nightmare. The bureaucracy is supposedly too complex. The delays are supposedly too long. That's what they want you to believe. But I've been digging deeper. I've been making calls. I've been tracking the movement of metal, the flow of money, the panic in the voices of people who usually never panic. What I'm finding is that the licensing system isn't the real problem. The real problem is that there's no metal left to move. The COMEX vaults have been hemorrhaging inventory for months. The registered category, the metal actually available for delivery, has been dropping week after week. The official data has been managed, smoothed over, the real situation hidden. Until now. Until Shanghai decided to stop pretending. That $127 price isn't speculation. It's not a bubble, it's panic. It's industrial companies in China realizing that the flow of metal from the West has stopped. Not slowed down, stopped. The solar manufacturers, the electronics giants, the battery makers, they're looking at their supply chains and seeing nothing. Empty pipelines, broken promises, suppliers who can't deliver because their suppliers can't deliver because the vaults are empty. So they're bidding. They're bidding against each other for every available ounce. And when you have the world's largest manufacturing economy fighting over the scraps of a depleted supply chain, the price doesn't go up gradually, it explodes. Think about what this means for every industrial company in the West. Apple needs silver for iPhones. Tesla needs silver for solar panels and batteries. Samsung needs silver for semiconductors. Every major corporation depending on technology, renewable energy, modern electronics, they're all looking at the same supply chain. And that supply chain is pricing silver at $127 in the only market where you can actually get metal. So what happens when these companies can't get silver from China anymore? What happens when they turn to the Western suppliers and find out that the $74 price is fiction? What happens when they realize that if they want silver, if they need silver to keep their factories running, They have to pay the Shanghai price? They'll pay it. They have no choice. The cost of silver in an iPhone is microscopic compared to the cost of shutting down the iPhone factory. The cost of silver in a Tesla battery is nothing compared to the cost of stopping Tesla production. But when they pay Shanghai prices for Western metal, the COMEX fiction collapses. When Apple pays $127 per ounce for silver in New York, that becomes the new floor. The paper price, the fantasy price, the managed price dies instantly. And that's when the real panic begins. Because every pension fund, every mutual fund, every institutional investor that's been avoiding precious metals because they looked expensive at $74 will realize that 74 was actually the bargain of the century. The rush to get in won't be gradual. It won't be orderly. It'll be violent. Because when a market has been artificially suppressed for years, when the real price has been hidden behind paper manipulation and currency games, the snapback doesn't follow normal rules. We're looking at the collapse of a 40-year price suppression scheme. The moment when reality overwhelms fiction. When the East stops accepting Western prices for Eastern metal. The silence from major banks is deafening. JP Morgan, Goldman Sachs, HSBC aren't commenting, aren't explaining, aren't reassuring anyone this is temporary. That silence tells you they know what's coming. That silence tells you they're positioned for it. Remember, these banks aren't just market makers. They're market owners. They've been accumulating physical metal for years while manipulating paper prices lower. They've been using their own suppression scheme to build massive stockpiles at artificial discounts. Now they're watching the Shanghai market reveal the true value of those stockpiles. They're watching their paper enemies, the pension funds and retail investors who believed in their manipulation, realize they've been locked out of the greatest wealth transfer in modern history. The $53 spread isn't a market inefficiency. It's a declaration of war. It's China telling the Western financial system that the game is over, that they're not accepting Western prices anymore, that if the West wants Chinese silver, they'll pay Chinese prices. But here's the terrifying part for Western governments. Silver isn't just an industrial metal, it's a monetary metal. It's been money for 5,000 years. And when the price of money starts divorcing between East and West, when the basic unit of value becomes geographically split, the implications go far beyond commodity markets. We're looking at the breakdown of the dollar-based pricing system. We're looking at the emergence of two separate financial realities. One in the West built on paper and promises. One in the East built on physical assets and manufacturing capacity. The Shanghai price is telling you which reality is winning. The COMEX price is telling you how much the West is willing to lie to itself to avoid facing that reality. But lies don't smelt into solar panels. Lies don't conduct electricity. Lies don't power the factories that make the products that run the modern world. And when the lying stops, when the paper burns, when the systems collapse under the weight of their own contradictions, the people holding the real things will inherit everything. The people holding the promises will inherit nothing. The $53 spread is the distance between those two outcomes. And that distance is growing wider by the hour. By the time the mainstream media admits what's happening, by the time the banks stop pretending they can manage this, by the time the Western markets acknowledge the Shanghai price, it will already be too late for anyone who isn't already positioned. The arbitrage death isn't just about silver. It's about the death of the system that made silver cheap. And when that system dies, everything built on its lies dies with it. But let me tell you what's happening behind the scenes right now. What's happening in the emergency meetings that started 3 hours ago in Lower Manhattan? I'm getting reports from sources inside the major banks. Reports that should terrify every person who understands how this system actually works. The risk management systems are screaming. The computers that monitor exposure, that calculate margin requirements, that measure counterparty risk, they're flashing red across every major institution. Because when silver is trading at $127 in the only market where you can actually buy it, but your book still shows 74, you have a problem. A massive, mathematical, unavoidable problem. Every short position opened below 127 is underwater. Not on paper, not theoretically. Actually underwater in the real world, where real transactions happen at real prices. But here's what's really keeping the risk managers awake. The derivative exposure. Silver isn't just silver anymore, it's collateral for currency swaps. It's backing for commodity-linked bonds. It's the foundation under mining company loans and industrial credit facilities. When the price discovery mechanism breaks this completely, when East and West are operating in completely different realities, every derivative contract becomes impossible to value. Every hedged position becomes unhedgeable. Every risk model becomes worthless. The Federal Reserve knows this. They've been monitoring the situation since the Shanghai opening. I'm told there have been at least 4 emergency conference calls between New York Fed officials and the major dealer banks. 4 calls in 6 hours. That's not routine market oversight. That's crisis management. And what are they discussing? How to contain the contagion. How to prevent the Shanghai price from infecting the Western markets. How to maintain the fiction that $74 is the real price while the rest of the world moves toward 127. But containment requires isolation, and isolation requires cutting the financial arteries that connect East and West. The very arteries that make global trade possible. Think about what this means for the companies that depend on those arteries. The multinational corporations that source materials in China and sell products in America. The banks that finance trade between continents. The insurance companies that guarantee delivery of goods across oceans. They're all looking at the same impossible choice. Operate in a world where the same metal has 2 different prices, or pick a side and abandon half their business. Most of them will pick the Shanghai side, because Shanghai has the metal. Shanghai has the factories. Shanghai has the capacity to actually produce the things the world needs. New York has paper. New York has promises. New York has a regulatory structure built around assets that may not actually exist in the quantities claimed. And that's the real crisis hiding inside this $53 spread. It's not just that arbitrage is dead, it's that the discovery of dead arbitrage is revealing how much of the Western financial system is built on fictional foundations. The COMEX warehouse reports, the registered inventory numbers, the delivery capacity claims, they've all been accepted on faith for decades. Nobody questioned them because nobody had to. The system worked smoothly as long as everyone agreed to pretend the paper represented the metal. But when China stops pretending, when Chinese buyers start demanding actual delivery at actual prices, the whole structure starts shaking. And when it shakes hard enough, people start asking uncomfortable questions. Questions like, if silver is really $74, why can't I buy any at that price? Questions like, if the warehouses are really full, why are delivery delays stretching into months? Questions like, if the market is really functioning, why does the same metal cost $53 more on one exchange than another? Those are the questions that end financial regimes. Those are the questions that topple currencies. Those are the questions that force entire systems to collapse under the weight of their own contradictions. And once those questions start being asked, once the public starts demanding real answers instead of regulatory doublespeak, the endgame accelerates beyond anyone's ability to control it. Because the truth, the mathematical, undeniable physical truth, is that there isn't enough silver at any price to satisfy the demand that's been building for years. The deficit isn't theoretical. The shortage isn't coming. It's here, it's now. And it's being hidden by price suppression schemes that are falling apart in real time. The Shanghai price isn't high because of speculation or manipulation or Chinese market dysfunction. The Shanghai price is high because it's the first honest price we've seen in decades. It's what silver costs when you actually have to deliver the metal, instead of just promising to deliver it someday. And when honesty spreads, when other markets start pricing reality instead of fantasy, $74 won't just look cheap. It'll look like ancient history. The $53 spread is growing because the forces driving it are accelerating. Chinese demand isn't decreasing. Western supply isn't increasing. The export restrictions aren't loosening. The delivery problems aren't solving themselves. Every hour that passes, every ounce that gets consumed, every factory that needs metal, every solar panel that gets built makes the gap wider, makes the arbitrage deader, makes the system more broken. And broken systems don't heal themselves. They collapse, usually quickly. Usually when the people running them finally admit they can't maintain the illusion anymore. That admission might come tomorrow, it might come next week. But when the Western markets acknowledge the Shanghai reality, the price won't drift slowly from 74 to 127. It'll gap there instantly, overnight, without warning. Because that's how broken systems fail. Not gradually, not with plenty of time to adjust. Suddenly, violently, completely. The arbitrage death is the warning signal. The system collapse is what comes next. But I need to tell you about the calls I've been receiving. Calls from procurement managers at major electronics manufacturers. Calls from supply chain directors at renewable energy companies. Calls from traders who've been in this business for decades. They're all saying the same thing. The physical market has disappeared. Not slowed down, not become expensive. Disappeared. One semiconductor procurement manager told me they've been calling suppliers for 3 days trying to secure industrial silver for spring production. Every supplier has told them the same thing. No availability, no timeline, no guarantees. These are industrial users who typically order thousands of ounces at a time, who have established relationships with major refiners, who pay premium prices for guaranteed delivery. They can't get metal at any price. The solar industry is in complete panic. Companies building the green energy future are looking at supply chains that have evaporated. One executive told me his company halted expansion plans because they can't guarantee silver availability beyond 60 days. For an industry that plans in 5-year cycles, that's economic death. These disruptions are cascading through every sector depending on silver. Electronics, automotive, medical devices, defense contractors, renewable energy, jewelry manufacturers. The entire industrial ecosystem relying on silver is discovering simultaneously that the metal they've budgeted for at $70 to $80 simply doesn't exist at those prices. It exists at $127 in Shanghai, where they can't buy it. This is creating a procurement nightmare that goes far beyond silver itself. Because modern supply chains are integrated systems. When one critical component becomes unavailable, entire production lines shut down. When silver deliveries fail, solar panel production stops. When solar panel production stops, renewable energy projects get delayed. When renewable energy projects get delayed, government climate targets become impossible to meet. When climate targets fail, political promises collapse. The ripple effects of dead arbitrage don't stay contained in commodity markets. They spread through the real economy like a virus, and the geopolitical implications are staggering. What we're watching is China weaponizing industrial dependency. They're demonstrating to the West how vulnerable our technological civilization has become. Every smartphone, every electric vehicle, every solar installation depends on materials China controls. The $53 spread isn't just market anomaly, it's a demonstration of power. China telling the West, you built your economy on our materials, price them in your currency according to your rules. That arrangement is ending. This is financial warfare disguised as market forces, and the West is losing. But here's what keeps me up at night: the individual implications. Because while governments and corporations are scrambling to manage this crisis, individual investors are walking around completely unaware that their financial reality is about to change forever. The retirement accounts invested in technology funds. The pension plans loaded with renewable energy stocks. The mutual funds that depend on industrial companies maintaining their profit margins. All of these are about to get hit by a supply chain crisis that will make the semiconductor shortage look like a minor inconvenience. When Apple can't get silver for iPhones, Apple stock doesn't decline gradually. It gaps down as investors realize the company's business model depends on materials they can't access. When Tesla can't get silver for solar panels and batteries, Tesla's valuation doesn't adjust slowly. It collapses as the market realizes their production targets are physically impossible. When renewable energy discovers they can't access materials needed for solar installations, clean energy stocks don't have a correction. They have catastrophic repricing. And the people hurt worst will be those who believed the system was stable, who trusted markets were efficient, who thought arbitrage was automatic and prices rational. They're about to learn that efficiency and rationality were illusions maintained by a power structure dissolving in real time. The Shanghai price is reality. The COMEX price is the last gasp of a system that's already dead but doesn't know it yet. And when systems die, they don't send out polite notifications. They don't provide transition periods. They just stop working. The arbitrage death we're witnessing isn't the beginning of a process. It's the end of one. The process where Western financial markets dictated global prices through paper manipulation has already ended. What we're seeing now is just the recognition phase, the moment when reality overwhelms illusion. And that recognition, when it becomes widespread, when it becomes unavoidable, will reshape everything. The question isn't whether this will happen. The question is whether you'll be ready when it does.